Hello and welcome to my presentation. My name is Mutemi Kiraithe and this is Capstone project for World Quant University. My study is using short-term trading strategies in beating the market, and the project was carried on in December 2018. Welcome, and this is my presentation for the study. We'll start with the outlay or the format that has been used to develop this study, and that is the project content, starting with the abstract, then introduction to the study with the background to the study. There's the data used that we will be discussing, the methodology used in developing the study, and the performance metrics that will be used to track the performance of the alpha. Empirical results will be discussed at the end of the study, and conclusions that will be drawn from the results and recommendations. Let's start with the abstract. The purpose of this study was to analyze the use of short-term trading strategies to beat the market. And these short-term trading strategies are the trend-following strategies. And these include momentum and moving average strategies. The project aims to develop an alpha for a short-term trader that will generate better returns than the average market returns. The average market returns here, we mean the S&P 500 or the Dow Jones Index for stocks. Let's go through introduction to the study. The short-term trading strategies involves buying and selling of securities, considering a short-term profit movement occasioned by price movement or the volumes movement that lasts from few seconds to few months. Short-term trading can be very profitable and very risky at the same time. That's according to risk-return trade-off. The higher the risk, the higher the returns. And we look at the efficient market hypothesis, which asserts that it is difficult to beat the market due to the new information assumption in the market. But the fact is that some of the participants of market have in the past been able to consistently beat the market, especially high-frequency traders and hedge fund traders. We also note that profitable trading strategies have been attributed to information asymmetry in the securities market and the psychology of the investor, plus the semi-structured nonlinear stock market nature. So those are the arguments for beating the market. Let us look at the fundamental and technical analysis, which are key ones in this study. And fundamental analysis evaluates a security by assessing its intrinsic value or examining the related financial and economic factors surrounding the company or the securities company. This helps in understanding if the security is undervalued or overvalued. It identifies fundamentally strong companies or industries and fundamentally weak companies or industries. The data that was used to study this was from Yahoo Finance, specifically for Dow Jones Industrial Average as the market index benchmark, and specifically General Electric data for a period of 2 years, and also I used the Cisco stock security. Purely, this study adopts technical analysis that looks at price movements occasioned by at the same time, we look at the methodology and we start with the momentum. Downloaded data was analyzed using Python 3.6 environment and the results presented in the results section. 4 momentum periods were set at 14, 42, 90 and 180 days. Strategy was developed based on each period as a result compared. Rising prices will continue rising and falling prices will continue following. And this is the assumption made when using trends. Still on momentum, the relative strength index oscillates between 0 and 100, and this study considers RSI when above 70 to be overbought and oversold when below 30. This is an indicator for buy or sell signal. Then downward momentum will be confirmed when short-term average crosses below the long-term average. That means it's the sell signal. And upward momentum will signal buy or hold. Those are the signals that will be or have been considered in this study as far as momentum is concerned. Let's look at moving averages. And a short-term average, which ranges from 5 to 15 days, was set at 14 days, while the longer-term average of range 50 to 90 is set at 90 days. To devise a rule to generate all our trading signal using 3 basic rules, buy signal or go long will be signaled when the 14-day moving average is for the first time X points above a 90-day trend. I used 0. That means when it crosses the 90-day average. Then you pack in cash if there is no change. Let's look at the performance metrics. The Sharpe ratio, which is the average returns earned in excess of the risk-free rate per unit of volatility in the stock market. And volatility represents the risk of an asset. Then another performance metric is drawdown, which is the reduction of one's capital after a series of losing trades. This is usually calculated by getting the difference between a relative peak in capital and the relative trough. A formula for Sharpe ratio has been shared. Now let's move into empirical results. And for GE ticker, momentum strategy performance based on those periods of 14, 42, 90 and 180 days shows that strategy 180 day is the best performing, far much better than the other strategies. And for Cisco ticker, also 180-day strategy does the best, followed by it is followed closely by strategy 14. Moving averages were plotted, that is the 14-day moving average, 90-day moving average, together with the adjacent close prices that were used for the data. And for the two stocks, Cisco is on upward trend, while for General Electric ticker, it is on downward trend. From 2016, the prices are moving down from close to 30 to almost less than 20. The points of crossover are very important to us, because when a short-term moving average, say the 14-day moving average, is above a long-term moving average, which is 90-day, that means that the trend is higher or bullish, and the vice versa. Moving averages can also be used to identify trend reversals, such as a price crossover. The prices are on downward trend in general. A death cross is considered a bearish signal, and it occurs when the 14-day moving average drops below 90-day moving average. This was observed in on March 2017 for GE. The plot or the graph for these crossovers looks different for Cisco and for General Electric. And for this case, there were only 2 points of crossover for GE on around June 2018. But for Cisco, there are more than one, which means it's more volatile than the General Electric ticker. These points of crossover showing when to buy or to sell. Let us look at General Electric ticker alpha performance that has been developed against the benchmark of the broader market, that is Dow Jones Industrial Average returns, and the returns of this ticker on buy and hold strategy. And clearly, in the month of December 2018, momentum strategy and moving average alpha generated excess returns than the market returns. The same way, Cisco alpha performance. Here, the buy and hold strategy is the best performing, but still followed by momentum strategy, affirming the importance of momentum. For this case, our moving average strategy has not done very well, but because we have the two, moving average and the momentum, the trader can choose the best performing. And here, if we go by momentum strategy, it still beats the Dow Jones Industrial Average, which is the broader market returns. On performance metrics, the results shows that the annualized Sharpe ratio calculations shows that the Sharpe ratio for momentum strategy is 41%. This is quite high as compared to the Sharpe ratio for Cisco, which is 19. Moving average strategy for GE ticker is at 30, and for Cisco it's 3. For the Jones Industrial Average, it's constant, that's at 17.06. And this means that the higher the Sharpe ratio, the more the returns risk has been managed. Conclusions drawn shows that efficiency market hypothesis does not hold true always, especially for these particular securities that have been tested, because despite the new information coming in, the trader would still beat the market. Short-term active strategies following trends can deliver better results than the broader market returns, contrary to efficient market hypothesis. And this is evident from the results. Other things that were affected were ATR, or average true range, to guide the trader not to exit the trades when it's not supposed to be. And that has been my presentation, and thank you. References used are as shown. It is great pleasure, and this study has been so meaningful to me, and